Hello and welcome. Today, we're going to tackle one of the most essential skills in accounting, analyzing and recording business transactions. By the end of this video, you'll be able to look at a business event, figure out how it affects the company financially, and record it like a pro. So, where do we start? With the single most important rule in all of accounting, the basic accounting equation. Everything revolves around this formula. Assets equals liabilities plus stockholders' equity. Assets are the resources a company owns. Liabilities and stockholders' equity are the claims on those resources. Liabilities are claims by creditors, and equity represents the claims by owners. To record transactions, we use a system of debits and credits. Don't think of them as good or bad. Think of them simply as left and right. Every transaction will have at least one debit and one credit, and the total debits must always equal the total credits. Here's the key to it all. Look at how debits and credits affect each part of the equation. Assets increase with a debit. Liabilities and stockholders' equity increase with a credit. We can expand the equity section to better understand it. Stockholders' equity is made up of common stock and retained earnings. Retained earnings is then affected by revenues, expenses, and dividends. This gives us a handy mnemonic: dealer, dividends, expenses, assets. These accounts all increase with a debit. The other accounts, liabilities, equity, and revenues, increase with a credit. If you remember dealer, you'll know how to handle almost any transaction. Finally, the specific accounts we use come from a list called the chart of accounts. Think of this as our menu of approved account titles. We can't just make up names. We have to use the accounts the company has established. Okay, foundation laid. Let's get to work and see this in action. Okay, transaction 1. Eagle issues common stock for $200,000 cash. What's happening? The company is getting cash, and in return, it's giving ownership shares to stockholders. The two accounts affected are cash and common stock. Cash is an asset. Our assets are increasing, and assets increase with a debit. Common stock is a stockholder's equity account. Equity is also increasing, and equity increases with a credit. So, we debit cash and credit common stock. Let's record this. On the 1st of December, we debit cash for $200,000. We credit common stock for $200,000. Then, we post this to our T accounts. Okay, what's happening next? The company is increasing its cash, but it didn't earn it. It borrowed it. This creates a formal obligation to pay the bank back. So, the two accounts involved are cash and a liability called notes payable. First, cash is an asset, and it's increasing. Based on our rules, assets increase with a debit. Second, notes payable is a liability. Our liabilities are increasing because we now owe the bank money. Liabilities increase with a credit. So, we will debit cash for $100,000 and credit notes payable for $100,000. Then, we post that to our T accounts. Transaction 3. We buy $120,000 of equipment using cash. What's happening? One asset, equipment, is going up. Another asset, cash, is going down. According to our rules, an increase to an asset, equipment, is a debit. A decrease to an asset, cash, is a credit. This is an asset exchange. One asset goes up and another goes down. The entry is a debit to equipment for $120,000 and a credit to cash for $120,000. Then, we post it. Transaction 4. This is a very important type of transaction. We are paying cash now for something we will use later, in this case, a place to operate for the next year. Because we have a right to this future benefit, we've acquired an asset. The accounts are prepaid rent and cash. Prepaid rent is an asset, and it's increasing, so we debit it. At the same time, another asset, cash, is decreasing because we paid it out. A decrease to an asset is a credit. This is what we call an asset exchange. One asset goes up and another goes down. The entry is a debit to prepaid rent for $60,000 and a credit to cash for $60,000. Transaction 5. Here we acquire another asset, supplies. But notice the key phrase, on account. This means we didn't use cash. We promised to pay our supplier in the future. This creates a liability. Our accounts are supplies and accounts payable. Supplies is an asset, and it's increasing. Assets increase with a debit. Accounts payable is a liability, representing our informal promise to pay. Our liabilities are increasing, and liabilities increase with a credit. We'll debit supplies for $23,000 and credit accounts payable for $23,000. Transaction 6. We earned $43,000 in cash for providing soccer training. Our cash and asset is increasing, so we debit cash. We also earned revenue, which increases stockholders' equity. Revenue increases with a credit, so we credit service revenue. The entry is a debit to cash for $43,000 and a credit to service revenue for $43,000. Transaction 7. Similar to Transaction 6, we provided a service and earned revenue. But this time, the customer didn't pay us cash immediately. They will pay us later. This gives us a right to receive cash in the future, which is an asset called accounts receivable. Accounts receivable is an asset, and it's increasing. Assets increase with a debit. We also earned revenue, which increases equity. Revenues increase with a credit. Remember, the revenue is earned when the service is provided, not necessarily when cash is received. The entry is a debit to accounts receivable for $20,000 and a credit to service revenue for $20,000. Transaction 8. Now for the flip side of a prepaid asset. A customer paid us cash before we've done the work. We have their cash, but we now have an obligation to provide training in the future. This obligation is a liability. The accounts are cash and deferred revenue. Our asset, cash, is increasing, so we debit cash. Our liability, deferred revenue, is also increasing. Liabilities increase with a credit. It is crucial to understand that this is not revenue yet because we haven't earned it. We debit cash for $6,000 and credit the liability account, deferred revenue, for $6,000. Transaction 8. We paid $28,000 in salaries. This is an expense. Remember our dealer mnemonic? Expenses increase with a debit. So, we debit salaries expense. We paid with cash, so our asset cash decreases. A decrease to an asset is a credit. So, we will debit salaries expense for $28,000 and credit cash for $28,000. Transaction 10. Finally, the company decides to distribute some of its earnings back to its owners. This is a dividend. A dividend is a distribution of wealth. It is not an expense of doing business. The accounts affected are dividends and cash. Let's go back to our mnemonic, dealer. The D stands for dividends. Dividends increase with a debit. They work against equity, reducing the company's retained earnings. We paid with cash, so our asset, cash, is decreasing, which requires a credit. We will debit the dividends account for $4,000 and credit cash for $4,000. And there you have it. We've analyzed 10 different transactions, created the journal entries, and posted them to the general ledger using T accounts. Notice that for every single transaction, the debits equaled the credits. We used our framework, the accounting equation, and the dealer rules to guide us every time.